look at things a little more from a longer term perspective. So I'll give you the broader picture. I mean, you will have different investors having different investment horizon. Someone would talk more about a 6-month horizon, someone would talk about 1-2 years. Typically what we look at is more like a next 5-10 years. When we evaluate companies, we look at them from a next 20 years perspective. What is the growth potential, what is the implied growth that the current price is reflecting. So we look at lot more long term. Many of you might say this is totally irrelevant because the markets keep moving every second or every day. But in hindsight, when you have the longer term picture, that helps you take a little more educated call when there is exuberance, because markets always have a sentiment, because market is made of people like you and me. So it always has a sentiment, and it always has greed and fear. At some point in time, the entire market is in total greed, like 2007. I mean, probably at the peak, all of us believed that everything, only the best can happen, and to that extent, the markets were at all-time high. Especially when already globally there were some issues. I mean, Lehman crisis had happened. Even after that, we were still okay for some time. So the bear stance issue had happened a lot earlier, but still the music probably stopped, and we didn't realize the music stopped. That was on the greed side. Again, on the panic side, much more recently, like in 2020, where we believed, I mean, in a matter of 20 days, we lost about 30-35% of the market value, because none of us knew how this is going to play out. COVID is going to play out, and what is going to happen to the businesses and companies. So there was panic and there was fear, and that's why we saw the other extreme. So the markets have emotions because of people like you and me, and that is where it will never be rational. I mean, if this is the rational line for a stock price, it will never be this rational line. It will always be above or below that. But this line gives you that support ki, eventually it will come back to this line. So the mean reversion will work in that way. So that's where the longer term 10-year or a 20-year picture clearly helps. And you would have heard many of the CEOs, global CEOs, come to India and say this is India's decade, this is India's century, and all of that. Just trying to highlight how much of that is reality, what is really positive about India. So first thing, if you see on the left hand side, is India's contribution to world GDP. So today, if you see the longer term picture, probably till 2008 we were around 3.5%. Then we moved to that 5.5% for the last 10 years. Now we are actually accelerating to almost 6.5 to 7%. Now, which means that India will grow much faster than the world economy. Now, why is India likely to grow faster than the world economy? The first part is, if you see on the right hand side, that is the addition of people in the age of 30 to 60. Probably the working age, you could even take, some people take 15 to 64, whichever number you take it. Basically, amongst all large economies, India is the only one which will add lot of people in the working age in the next 20 years. China's working age population is already declining. US is probably flattish. Most countries it is flattish or neutral or negative. India is the only country where we will be adding close to 1 crore people to the job market every year. Right? Probably the graduates in a year is around 6 to 7 million or 60 to 70 lakhs. But overall, if we look at, probably we will be adding close to 1 crore people to the job market in a year. So to that extent, we could have lot more people working in the next 20 years, while other economies, people will retire and they will become dependent. So our dependency ratio is going to still continue to be better compared to others. India's average age today is 28 years. Probably for China, US, most other economies, it is 38-40. We are at 28, we will move to 38 probably in the next 15-20 years. So India is going to be a young nation for the next 20 years. We'll add lot of people to the working age in the next 20 years, and especially many of them will be educated as well. So on the upper end, we'll be able to do IT kind of a job or consulting kind of a job, which is high paying, high remunerative. So whether it is domestic or export, that is something which is very positive. And the second one, like I said, dependency ratio is going to be far lower. पहले घर में अगर 5-6 जन होते थे, एक कमाने वाला होता था. आज के डेट पे अगर हम देखेंगे, we are in a situation where the family size itself has come down. Nuclearization of family is happening, where we are having hardly 3 or 4 people in a family, and there are 2 people working. So पहले 1:6 था, आज 2:4 है. So you suddenly see that there is lot more disposable income in the hands of the family at the end of the month. आपके पास disposable income ज़्यादा होगा तो आप you will start to go for the tours, domestic tour, international tour, you will buy a house, you will buy a car. So that is the consumption boom which keeps continuing. And India will add lot of people to the job market in the next 10-20 years, and lot of people will move from that aspiring or lower middle class to higher middle class, where they will consume lot of these discretionary items. So that itself will help our growth. Besides that, like I said, I mean, from an export perspective, India is an English speaking country. Very few other countries who compete with us can have this potential. While we might be behind on manufacturing, China is better, even Vietnam, Thailand, Taiwan, many of the other countries are better off on the manufacturing side. But on the services side, we are much better off now, and probably that will be the case in the next 10-20 years. So that's where we will be actually growing faster than the world, and probably the fastest amongst large economies. हम सब ने सुना है कि we are already the 5th largest economy, moving towards the 3rd largest, and so on. It's all mathematics. एक साल आगे पीछे हो सकता है, 2027 में होगा, 28 में होगा. That is least of the concern. The fact is we are moving in that direction. But at the same time, the opportunities कि आज भी हमारा per capita income $2,500 है, while majority of the world is at $20, $30, $40,000. So हमारा अभी तक penetration काफ़ी बाकी है. I mean, even in soaps and toothpaste and many of the discretionary items, like I said, going forward we will see this consumption happening as the income increases. So हमारा per capita income का भी growth का opportunity है, which many of the other countries have already matured. They've already reached there, and to that extent, maybe the growth may not be there as much. So mathematically also we are in a much better position, and this growth is likely to be there in the next 10 or 20 years. The other factor at this point in time, if you see, is the balance sheet of corporates. If you see the left hand side, that's the listed companies. Even if we add the unlisted companies, the direction is going to be the same. Aapka debt to equity has come down significantly in the last few years. Why is this happened? If we look at 2018-19, we had many corporates which had NPAs, which were NPAs for the banks, and there was problem. They were not able to pay the debt. उसके बाद with bankruptcy law and all of that, we saw many of these high debt companies get acquired or get sold out or going down. And from a bank perspective, the banks took the hit, they took the credit cost or NPAs and moved on. So today we have a situation where the bank's balance sheets are clean, the corporates' balance sheets are clean and lighter. Their debt to equity is at one of the lowest that you can see in the last 20 years. So which helps in the next capex cycle. आपका बैलेंस शीट ठीक है, डिमांड ठीक हो रहा है, कैपेसिटी यूटिलाइजेशन बढ़ रहा है, तो आप और एक प्लांट लगा सकते हो. पहले आप लगा नहीं सकते थे क्योंकि आपके पास डेट ज़्यादा बोरोइंग था, इंक्रीमेंटली बोरोइंग की डिफ़िकल्टी हो सकती थी. आज के डेट पे वो सिचुएशन नहीं है एट द सिस्टम लेवल. सो टू दैट एक्सटेंट, इफ़ देर इज़ डिमांड, इफ़ देर इज़ कैपेसिटी यूटिलाइजेशन, चाहे वो FMCG में हो, केमिकल में हो, पावर में हो, द कंपनीज आर इन अ पोजिशन टू काइंड ऑफ पुट फ्रेश केपेक्स. And broadly the economy has 2 parts or 3 parts at max, right? I mean, you have consumption, you have investment, and you have the government. Government actually plays majority in the investment, but some amount of consumption as well. So broadly that's 2, I mean, investment and consumption cycle. If you see 2003 to 12 era, that was the period when the GFCF is for investment, and PFC is for consumption. It's private final consumption expenditure. GFCF is gross fixed capital formation. So GFCF is investment cycle, and PFCE is the consumption cycle. आप ऑरेंज लाइन देखेंगे नीचे जा रहा था एंड ब्लू लाइन ऊपर जा रहा था, क्योंकि 100 रुपये में अगर आपने कम कंज्यूम किया तो ज़्यादा इन्वेस्ट करोगे, और वैसे वर्सा आपने ज़्यादा सेविंग किया तो उसको आप ज़्यादा इन्वेस्ट करोगे, जो बचा हुआ है उतना ही स्पेंड कर रहे हो. So that period was 2003 to 12 year period was investment cycle period, when consumption went down as a proportion of GDP. 2012 onwards, because of some of these NPA issues, some projects getting stuck, all of that, we didn't see fresh capex happening at a great pace. Consumption zyada hone laga. So that's where all the consumption cycle did very well, and the consumption stocks did very well. Now post COVID, again post the balance sheets becoming far better, we are seeing again the investment cycle starting to pick up. Especially the government capex has already come through. Now, like I said, since the balance sheet of private sector is stronger, with the capacity utilization going up, the private sector capex will also come through. It's a matter of time that will also come through. So probably we are somewhere in the middle as far as the investment cycle is concerned. Another point is, in investment we include real estate. I mean, the investment can be from the corporate, investment can be from the government, or investment can be from the household, right? So the corporate investment is like you put up factory for manufacturing some goods. The investment from the government can be you build a bridge, you build railways, defense, all of that. The investment from household is largely the cars and the houses that you buy. So the housing cycle kind of slowed down between this 2010 to 20. 2010 to 20, any market that you pick up, whether it is Bombay, Delhi, the top 10 cities, the prices did not go anywhere. And to that extent, the households also kind of postponed their decision to buy houses. Then RERA came, there has been consolidation in this industry also, there has been lot more transparency, and after that now people are confident and they are again starting to buy houses. Again post COVID, people have found the desire or the need to have bigger houses. So that's also leading to upgrade. If I was in a 2 BHK, I am trying to get into a 3 BHK and so on. So that is also leading to demand for housing. So housing cycle has started to do well again in the last 2-3 years. And typically housing cycle lasts for longer time, it could last for 8-10 years. So probably we are in that 2-3 years period. It could continue for longer unless something goes wrong. So to that extent, that is also an added advantage as far as capex cycle is concerned, because like I said, housing is a large part of the GDP. Now, housing, because it's not just housing, you have allied activities, you have cement, paint, at least 100 plus industries which are related to the housing ecosystem. So all of them benefit out of that. It was in the peak almost double digit of GDP, it went down to probably 5-6%. It's on the way up again. So that is something which can add to GDP growth in the next few years. So housing cycle looks good because again the individuals or the households debt is not much. The corporate cycle looks good because the corporate debt is not much anyways. And from a government side, again during COVID period, the government didn't spend or go overboard like probably some of the developed economies. Those are basically US में average citizen got probably $500,000 bill in their hands during that COVID period कि अब spend कर लो. Whereas in India we didn't have those kind of dolouts. Or most emerging markets didn't have that kind of dole-out because one, आपके पास balance sheet size भी नहीं था and you wanted to be prudent. So to that extent, the government balance sheet is not as much stretched as it is for probably US, Japan or many other economies. So our balance sheet, the government debt to GDP is still measured at a very reasonable rate of probably 85% if we add the center plus state. So the government balance sheet is also good, the corporate balance sheet is good, the household balance sheet is good. So the capex cycle should continue, and capex cycle continuing means lot of job creation. Initially I talked about 1 crore people hitting the job market. If we add both of this, hopefully we'll have the investment cycle also running, job creation also running. Eventually that helps in the consumption as well. The other important part, this is again, we've just put out a chart for the last 1 year. I will show subsequently even the longer term data. what has happened is last 1 year we've seen that small caps have given 75% returns, mid caps have given 60% returns, large caps have given 30% returns, and micro caps probably 100% returns, right? But how much of that has come from earnings and how much of that has come from re-rating? I mean, there are two ways the stock price can go up, right? One, it is backed by earnings, that is the EPS is going up. The other one is without EPS going up, you feel a lot more bullish. You say the value of this company is not X, it should be 2X or 3X. That's why you push the valuation up. So how much is due to the PE re-rating? How much is due to the earnings growth? If you see, earnings growth for all these categories has been broadly in that 18 to 25% range. So whether it is a large cap or a micro cap, broadly it has been that 18 to 25% range, but the stock price returns have been disproportionate. The smaller the market cap, bigger the returns. That's how it is played out. Or the other way to put it is, the more the illiquid the stock is, higher the returns. That's how it has happened in FY24 in the last 1 year. That is because a lot of money has chased equities as an asset class in the last 1 year. So there has been lot of re-rating in micro caps or small caps or mid caps, while it is very little in case of large caps. So to that extent, if at all there is some vulnerability in the market or risk to the market, the maximum risk is in a micro cap, then small cap, then mid cap, and probably least in a large cap. That's what we wanted to show. As long as the markets go up with earnings growth, it is always good. Only if there is far higher exuberance compared to the earnings growth, that is where the risk starts to stem in the system. The other thing is again fiscal deficit. The government has been very disciplined in the last many years. COVID is the period where suddenly they had to overshoot their spending because 3 months literally sab kuch band tha, so you had to still spend. So the government took that hit, but that's why their fiscal deficit went into double digit. But again, after that they have been on a glide path. Last year they were at 5.8, FY25 they are guiding for 5.1. Eventually FY26 they want to come to 4.5. What is fiscal deficit? You are borrowing from the future and you are spending today, right? I mean, so to that extent, you can only borrow limited amount from the future. Some of the governments, like I said, I mean, US or other countries, they've gone overboard. They've borrowed a lot from the future and spent, which means their future is a little more riskier compared to India. India still is far more measured, and going forward, they are going to be even curtailing that fiscal deficit. The good part, other good part is, if we see income tax, this is almost 40 years data from 1985 to 2025. The line trend is that as a percentage of GDP, it has been inching up. So it is because one, compliance, earlier very few people paid tax, today more and more people are paying tax. The second one is the incomes are growing. I mean, so earlier you were in a 10% slab, you are moving to 20% slab, you are moving to 30% slab. So automatically that also helps. So both of these put together, today the income tax contribution is inching up to 3.5–4%. Right? Income taxes, personally you and me, whatever income tax that we pay, or the corporates, whatever tax they pay, these are the direct taxes. So that has been on an upward trend. What it means is, if the government gets more money through taxes, it has more wherewithal to spend on metros, on infrastructure, on say directed spending. Okay, I want to focus on solar energy, I want to focus on mobile manufacturing, whatever they want to, they can give sobs for that and get that to grow. So the more the money in the hands of government, you will have better growth for the economy. In terms of the infrastructure. So that is something which is positive. Structurally it has been going up. Like I said, as more and more people get into the employment, you will have this number only further increasing. Again, on the right hand side, GST, it doesn't have so much of history, so we've just taken the last 3–4 years, but within that short period also, again we've seen a huge compliance increase. So there have been probably millions of people who got added into the indirect taxes net, because GST ensures that more and more people slowly get compliant and start to pay the taxes. Incrementally it becomes very difficult for someone to do business and not pay the GST. So that's where you're seeing the compliance starting to increase, and there also, like I said, direct taxes is going up, even the indirect taxes are going up. So direct taxes and indirect taxes going up means more revenue for the government, which means more spending ability, whether it is capital spending or revenue spending, there is more spending ability for the government. So that is something which is structurally positive for India. I'll skip these, but other thing is, last few years we've seen more and more spending focus of government on the capex side rather than the revenue expenditure. That is because capex is, you spend, like I said, I mean, you build a bridge, you build a road, you build defense capabilities which last for years. While revenue expenditure is whatever salaries you have to pay, whatever expenses you have to meet in this very year, the benefit of which ends in this year itself. It doesn't go into the next year. I mean, all of you know accounts. I mean, what is P&L item, what is balance sheet item? It's something similar to that. Revex is more a P&L item, while capex is something which will last for much longer period. So government has said, let us create more assets that will help the economy. So that's where incrementally the capex proportion and the overall government expenditure has been going up. Net, in summary, what I would say is, we are looking at probably last 20 years GDP, real GDP growth would have been 6 odd %. The next 10-20 years, can we grow at 6 to 7%? Probably the answer is yes. Last 20 years, China would have grown at 9%. Can they grow at 9% the next 10-20 years? Seems very difficult, because today they are the second largest economy, close to $20 trillion after US. On this base, and with a declining working age population and population also declining, it's almost impossible for them to kind of grow. Most probably they will be growing at 4 to 5%. Even if they grow at 4 to 5%, it's a big achievement. So we'll already be the largest amongst the top 5, top 6 economies. We'll be the fastest growing economy from a next 10-year or a 20-year perspective. The other factor, like I said, demographics is very much in our favor. We are a young nation, more people getting into the job market. The third factor is the starting point of per capita income. We are at $2,500. From here, we can only go up. So that is something which is very positive. Other big factor which can work in favor of India is, for any country, the biggest factor is the energy capability of the country, right? In India, unfortunately, we import 80% of our crude requirement. With solar power becoming a lot more affordable and the government's focus on solar power in the next 8-10 years, if we start to manufacture a lot more through solar energy, the power requirement is met through solar energy, that would make us self-sufficient rather than importing. The more and more we start to do that, the more and more self-sufficient we become, because we are tapping the solar power from here rather than depending on any other oil producing nation. So the equation suddenly starts to change and we become powerful. Our negotiations with the world for trade becomes far more better. So it's a structural slow change that can happen for India. We have ample of sunlight, ample of land for tapping this solar energy. So that is a structural trend which can again play out in the next 10-20 years. So we'll be a fastest growing nation, youngest nation, and self-sufficient on energy. That will help our overall numbers. Per capita income going up will help a lot more on the consumption side. Fiscal deficit is under control. Current account deficit has been coming under control. If we see 2013, when the Fed taper tantrum happened, our current account deficit shot up to 5-6%. Because crude prices went up, rupee depreciated, we are a net importer of crude, that impacted. Lot of gold import was happening, that also impacted us. So we were having a current account deficit which was unmanageable. Today there is enough forex reserves with us. Like I said, on the export services we are doing far better. India's GDP share is 3.5% in nominal terms. What I showed you is real term. In nominal term, we would be 3.5 trillion on 100 trillion broadly, so we are at 3.5%. But our export share is at 4.2 or 4.3. So in global trade, on the services side, we are doing much better. It's only on the goods side we are little under index, but on export services we are probably at 4.2. thanks to our IT exports, and now incrementally even the GCCs, that is the Global Capability Center, which is nothing but JP Morgan or any other bank or any other industry having a back office here for the accounting or the services need. So that is also an export which helps the country. So we are in a much better position as far as current account deficit is also concerned. The other good part is till 2014 we had high consumer inflation, almost 8 to 10%. Part of it also because of Narega, because Narega suddenly gave a lot more money in the hands of the bottom of the pyramid, and they wanted to consume protein. So you suddenly saw demand for eggs, milk, all of that going up, and the inflation, protein inflation as they called it at that point in time, led to overall food inflation and inflation starting to inch up. All of that is in the base now. The RBI lot more post that has been focused, the MPC committee has been formed and the RBI has been focused on keeping inflation around 4%. So broadly it is around 5 or 6, I mean on an average around 5 odd percent. We are no more in that 8 to 10% region. So lower inflation structurally is also something which is positive. The star cases in 2022, when US also faced a 6-7% inflation, India still had reasonably better control. For us 6-7% is not something alarming that we have not seen. For them who have not seen such kind of inflation for 30-40 years, 7% meant a lot. So that way we are far more in control as far as inflation is also concerned. So structurally everything looks quite good. We are in much better situation. Stock markets, all of you know, last 1 year has been very good for small and mid caps. I am not harping too much on that. If you look at versus other countries also, we've done exceedingly well in the last year. We are probably the second best country. Now this is something where I wanted to spend some time. This is the Nifty earnings growth, Nifty 50 earnings growth. 2010 to 2020, we more or less doubled our earnings. So probably we were at the 250, we moved broadly to 500 from 2010 to 20. 10 years mein double yani or CAGR is roughly 7%. But from 2020 to 2024, we have more than doubled again. We have grown at probably 17-18% CAGR. So in last 4 years post-COVID, the earnings growth has been very good. Like I said, if the market returns have come through because of earnings growth, that is a good, healthy market movement. You will not have so much risk. So that's where in large caps it has been lot more led by earnings growth. So to that extent, it is not so much of exuberance. It is lot more rational. This one that the markets have moved in line with earnings. Now, why from 2010 to 20 the earnings didn't come through is because 2010 to 20 you had cyclical companies, whether it's a global auto company or a steel company or corporate banks. All of this didn't contribute to earnings growth. Some of them even had negative growth, and to that extent the combined growth for Nifty 50 looked like single digit. It was only private banks, IT companies, consumer companies, retail companies which were growing, while many of these cyclical names had a negative or a low growth. Come 2020, most of these problems have been solved. Like I said, the investment cycle is also picked up. Now even the cyclical companies are seeing growth, and the structural companies anyways are growing like tortoise. I mean, they're compounders, they're growing at that 8 to 10% range. So that's where on a combined basis you are looking at double digit earnings growth, and double digit earnings growth is quite healthy. So that's something which we should bear in mind. But coming to valuations, if you look at Nifty 50 on a trailing basis, maybe we are just about reaching expensive. Forward basis, we are already getting into that expensive zone. But if we compare this with mid and small caps have gone to the other zone. They have completely gone into the expensive zone. So to that extent, what we are saying is large caps are still better than mid caps, and mid caps are still better than small caps. If you want to add, micro caps are further behind. So the larger the market cap, they are better off in valuations. The mid and small cap and micro caps are the ones where the expensiveness is. And equity versus bond yield, typically the green area is when you should buy lot more equities, and orange area is when you should buy lot more bonds. As of now, in the last 1.5–2 years, it has been indicating that you should have lot more bonds or fixed income because equity valuations are expensive. This is just an asset allocation tool. It doesn't mean that you should not own equities, you should own only fixed income. What it indicates is, for an evolved investor who already has enough wealth, if he already has say 60% in equity and 40% in debt, maybe at the margin he should shift 5–10% from equity to debt. It's just more for asset allocation, not a clear guide saying that equity over fixed income or fixed income over equity. It is just incrementally what you should be doing. That's what we highlight here. In summary, India looks very good from a next 10-year perspective on growth, on demographics, on most metrics. Valuation is the only one where there is little bit of discomfort. There also large caps look better compared to mid and small caps. So that's where, if someone wants to start afresh today, probably a multi-asset or a balanced advantage or large cap kind of categories are much better off. But if someone is in doing SIP, there is no need to really disturb that. The other data we have not put it out here, but what we've seen is, whenever this bond yield and the equity gap is extreme at this 2+%, the subsequent 1 year or 2 year equity returns generally tend to be muted. It can be 1–2% returns, but subsequent 5-year returns still can be 9–10%. So it is not bad if you are holding it for 5 years, but can the near term be bad? Chances are yes. As of now, is there any risk that we see? Maybe not something very alarming. Earnings growth is good. Government, probably there is continuity expectation built into the market. Reforms are doing very well. India is still the fastest growing. Macro wise, our forex reserves are good. Currency is behaving well. We are okay on most counts. But still, from a longer term perspective, what can be risks? We still are dependent on crude imports. So if the crude prices suddenly shoot up, that has an impact on our current account deficit, our inflation, our currency, all of that. The second one is the demographics that we are talking about. Still there is an execution risk left, that if those 1 crore people coming to the job market don't get employed properly, whether through jobs or whether through businesses or self-employment, if they don't get that opportunity, then the growth doesn't come through. There could be social unrest. So that is something that we need to still have a look out for. But broadly, other than this, we still seem largely okay. With that, quickly I'll talk about UTI large cap. This used to be called as Master Share earlier. This is one of the oldest funds, almost 37+ years history. Here we follow a strategy of GARP, that is growth at reasonable price, with focus on competitive advantage. We typically have 50 to 55 stocks. Being a large cap category, 80% plus has to be in large caps, and still we have room for 10 to 15% in mid and small caps. Why large caps? I was discussing with Sir also before this presentation. We've seen across industries consolidation. This is data from 2010 to 23. Whether you take banks, cement, paints, pharma, telecom, most sectors, you've seen the large have gained market share. I mean, the top 4, top 5, top 6 players have gained market share. So the large have become larger, which means if the industry grew at 10%, these companies grew at 12%. So the large have actually outgrown the mid and small. Ideally, you will see that, you will believe that small companies, because of their size advantage, should grow faster than the large companies. Because अब 100 रुपए में 20% grow करना is easier than 1000 रुपए में 20% grow करना. But somehow the reverse has only happened. The 1000 rupee guy has been able to grow 20% faster, while the 100 rupee guy has not been able to grow, because it's not been a broad-based growth. In stock market also, if you can correlate, 2018 mein there were a handful of stocks which did well. Majority of the stocks didn't do well. We called it Ritik stocks at that point in time, because majority of large cap stocks also didn't do well. The mid and small caps anyways underperformed after a stellar performance in 2017. That has happened because of this fact that there has been consolidation in the industry. Now, why consolidation has happened? 2010 to 20 has been a very tough period globally and locally as well. you've had demonetization, you have flood issues in some places, GST implementation, the continued slowdown, NPA issues, all of this. And that's where the companies, large companies which have seen cycles, who had better balance sheets, were in a position to kind of outgrow the industry. So that's where we've seen sector after sector, the large companies continue to outperform. Also, the other uniqueness about India is not really one India. I mean, we've seen FMCG companies talk about this, that India is many Indias combined together. I mean, you could say it is like a conglomerate or European Union. I mean, every 100, 200 kilometers, your language changes, your culture changes, your behavior changes, your food habits changes. So a company which is catering to pan India actually needs to understand the nuances of each local geography. So someone who has been there for 30, 40, 50 years understands these nuances, and they are better prepared to meet the demands of the local needs compared to smaller regional companies who have focused on one geography or two geographies, and they don't have that pan India presence. So that's where we've seen the large companies have been able to do much better than the mid and small companies. Hopefully, with this investment cycle picking up, we will see broadening of the economy, more mid and small companies doing well, new sectors emerging. But as of now, as we speak, in the last 13, 14 years, we've only seen the large getting larger. So to that extent, all the more reason that you should still be focusing on large companies. More from a tactical perspective also, we are at an extreme where the outperformance of mid and small caps is at an extreme versus the large caps, and typically after that, in the next 1 or 2 years, you see the large caps outperforming the mid and small caps. This is 1 year data. Even if you look at 5-year data, that's how it looks like. The yellow line is the mid cap, purple line is the large cap. On the right hand side, the dark yellow line is small cap and the purple line is large cap. The difference is widest between the two. This is 5-year rolling returns. So on a 5-year CAGR basis, the mid cap is at 22.5 and large cap is at 14.5. Means the gap is almost 7-8%, which is the maximum that it has got to in the last 10 years. Similarly, in small caps, again the gap is almost 8%, the maximum it has got to in the last 10 years. Which means post this subsequently, you see large caps outperforming the mid and small caps. So from a market perspective also, we are at a stage, it seems like large caps could be in a much better position than mid and small. Again, from a holding perspective, whether it is institutional holding or whether it is retail holding, already we've owned a lot more of mid and small caps compared to 2018-19. So to that extent, we are already owning a lot more mid and small caps. So the risks are higher for a correction in mid and small cap than in large caps. So that's where we are saying large cap is worth looking at more from a recent phenomena also and from a structural phenomena perspective as well. Now coming to UTI large cap, what we focus here is on competitive franchises, which in Warren Buffett language is MOAT. MOAT means, I mean, you have kind of a fortress and there is a water body in between, so that if there is an enemy who is coming in, you can get prepared and attack the enemy before he reaches your fort. So that's the water body is the moat that helps you or gives you that much extra time to prepare for the war. In business parlance, what it means is, if a company has this advantage, it will help the company last longer in tough times versus competition or versus external event. So the moat can be, for example, in a banking business, the cost of funds. I mean, if you have the lowest cost of funds, probably you will be the last man standing, because you don't have to take really high risks. आपका borrowing cost ही बहुत कम है, तो आप होम लोन और जी से खरीद के अपना बिजनेस चला सकते हो. आपका borrowing cost बहुत ज़्यादा होगा तो ही आपको पर्सनल लोन देना पड़ेगा या गोल्ड लोन या ये MFI लोन्स देने पड़ेंगे. So that way cost of funds itself can be a moat for a lending business. For a FMCG business, the brand itself can be the moat. I mean, toothpaste may be associated with the brand itself, and there is so much recall with the customer that you can easily sell. So the brand itself can act as a moat. In a paints business, the distribution reach that I talked about, India if you're able to reach every nook and corner, you know that in east during Pujo the demand will be very high, in south the demand will be high during Pongal time, in west probably around Diwali. So each place you know when the demand will rise sharply and which are the colors that are more favored in those regions. So all of those things acts as a moat for you. So a new company which comes and sets up shop will take its own time to understand all these nuances. So each company will have some kind of moat. What this moat helps is, like I said, during tough times they are the last man standing and they have better earnings growth visibility from a longer term perspective. So that's why we look at competitive franchises within the large caps. Large caps, as you know, is the top 100 companies by market capitalization. But within that also we look at some kind of advantage which we want to look at before owning those names. We have some names for moat. For example, I'll just take one large value retailer. Here the moat is that they supply you normal grocery items at the lowest possible cost. So as a customer you get the lowest possible cost, but still they make margins. How do they do that? They only store the most fast selling items so that the throughput is much higher in the store. कि मतलब line लगती है फटाफट, people buy those items and they move out. So वो same per square feet sales काफ़ी ज़्यादा होता है, तो कम मार्जिन में भी वो ज़्यादा प्रॉफिट बना लेते हैं, और हम और आप एज अ कस्टमर वी गेट अ मच बेटर वैल्यू कंपेयर टू आवर लोकल किराना शॉप. सो दैट्स हाउ दे हैव क्रिएटेड देयर मोड कि हम थ्रूपुट बढ़ाते रहेंगे, हमें पता चलेगा हाँ ये बिस्किट चलेगा तो यही बिस्किट रखता हूँ और 4 चीज़ें नहीं रखूँगा विच विल बी स्लो मूविंग, आई विल ओनली कीप द फास्ट मूविंग आइटम. सो दैट्स बीन देयर मोड विच इज हेल्प देम ग्रो disproportionately in the last many years. I'll skip some of these. The last slide I just wanted to focus on is that we've UTI large cap, because of this moat and the focus on quality, all of this, we generally tend to be kind of higher on quality, and that has been proved whenever there has been market correction. So we've had 7 instances of more than 20% BSE 100 correction in the last 20 years. And each time our UTI large cap funds fall has been lower than the benchmark fall. So on the way down we've been able to protect capital, and subsequently after that fall in the next 3 years and 5 years the returns have been anywhere from 50% to 150%. So that's where we are saying the quality of the portfolio, the moats of the companies helps us on the way down. We preserve capital on the way down. वापस ऊपर जाते वक्त even if we don't outperform, but because we've saved capital on the way down, through the cycle we are much better off in the overall returns. This is the 37-year history. The CAGR of BSE 100 is 14.43, while our CAGR is 15.6, probably about 1.17 higher returns. But the 10 lakhs invested would have become 15 crores in BSE 100. That would amount to would have been 22 crores. So time compounding magic, that 7 crore difference with just 1.2% higher returns is because of the time given. So that's the message we wanted to give. I'll stop here and happy to take questions.